Hello and welcome to the IFRS 17 training series. In this video, we will cover the General Measurement Approach, or GMA. So as an introduction, the General Measurement Approach is a valuation approach applied to many life contracts and contracts that are greater than 12 months. And it's also known as the building block approach because the GMA has three components. The first being the best estimate liability, the second the risk adjustment, and the third the contractual service margin. And you can picture that as a series of blocks. So we have our best estimate liability plus our risk adjustment plus our contractual service margin. Now the sum of the best estimate liability and the risk adjustment are known as the fulfillment cash flows. IFRS 17 defines the fulfillment cash flows as an explicit, unbiased, and probability-weighted estimate, or in other words, an expected value, of the present value of the future cash outflows minus the present value of the future cash inflows that will arise as the entity fulfills the insurance contracts, including a risk adjustment for non-financial risk. So in other words, our fulfillment cash flows are equal to the present value of our future outflows minus the present value of our future inflows plus our risk adjustment. Now, the present value of our future outflows minus the present value of our future inflows is also the best estimate liability. So our fulfillment cash flows are the best estimate liability plus the risk adjustment. So what is the best estimate liability? The definition is an unbiased and probability-weighted estimate of future cash flow. What that means, it's basically our expected value of the future cash flows discounted back to the valuation date. It's similar to what was done under IFRS 4 or COM, but there are some key differences. We still project out cash flows for insurance products using actuarial techniques, but there are some big key differences versus IFRS 4. The first, and I'll explain this in a bit, is the concept of a contract boundary. The second is what cash flows are included in that best estimate liability. The third is that we no longer have any implied or implicit margins. They are no longer allowed. And what an implied margin is, under the old IFRS 4, the actuary could set an assumption on a best estimate basis that would include some conservatism in it. For example, say we had a life insurance product and we were looking at the mortality assumption. We may look at the last 5 years for mortality experience and we might compare that to an industry table. And it might result in a actual to expected ratio of around, say, 63%. Well, the actuary might make a judgment call and include some implied margin and round that up to either 65 or say 70% of that table. Well, under IFRS 17, that's no longer allowed. The actuary would have to use a best estimate assumption with no implied margin, so they might use 63% of that table for the best estimate of that mortality assumption. And finally, the discounting approach is a very big difference between IFRS 17 and IFRS 4. And we'll cover that in a different video on discounting for life or P&C companies. So now let's talk about the contract boundary. And under our valuation, we need to project cash flows from the valuation date to the end of the contract boundary. And now when is that end of the contract boundary? Well, IFRS 17 states that a substantive obligation to provide services ends when either of the following occurs. So the entity has the practical ability to reassess the risks of a particular policyholder and as a result can set a price or level of benefits that fully reflects those risks. This point is key that it is tied to a particular policyholder. So for example, say an individual in the terms of an individual policy, or perhaps a group contract under group insurance. That group would be the policyholder. If you have the practical ability to set the price or level of benefits for that group or that individual policyholder, then that obligation would end when you have that right. So for example, with a 12-month auto contract, you might have the right to reset the price or change the level of benefits after 12 months. So the contract boundary would be 12 months. Same with, say, a group life policy, where after 12 months, you would have the right to issue a new price, either with a manual rate or with experience rating. And that 12-month period would be the contract boundary, because after those 12 months, you have the right to reset either the price or level of benefits. So the second qualifying criteria is that we need to satisfy both of the following. The entity has the practical ability to reassess the risks of a portfolio of insurance contracts that contain the contract, and as a result can set a price or level of benefits that fully reflects the risks of that portfolio. And the pricing of premiums for coverage up to that date when the risks are reassessed does not take into account the risks that relate to periods after the reassessment date. So what this means is you may not be able to set the price of an individual policyholder, but you can set the price of a collection of policyholders that have similar risks. So for example, this could be an adjustable life product where you can take a look at the pricing of that product as the entire group or portfolio of all the lives that are covered under that product, and you might be able to reassess the price every 12 months or 24 months or something. The key would be that the pricing of the premiums would only contain that next 12 months or that next 24 months. The pricing would not consider any future periods beyond that renewal period. So for example, say you had a 12-month contract, but part of that pricing or the premium also reflected some future benefits, say a reduced paid up amount down the road, or a cash value that's available down the road, or an endowment that's available down the road. If the pricing of the premiums includes a component, even though it may be fully adjustable every 12 months, if it includes a component that pre-funds some future benefit, then that wouldn't be satisfied. But in the alternative, if that pricing for the next 12 months only considers the risk over those next 12 or 24 months, then that would satisfy the second component. So to conclude, if you satisfy either A or both parts of B, that would determine when the contract boundary ends. And then you would project your best estimate liability from the valuation date to that end of the contract boundary. So what cash flows are included in the best estimate liability? Well, you would include premiums, any claims, including claims payable, incurred but not reported claims, future claims, if you're projecting a contract into the future, that's many years down the road, say a long-term life contract. You would also include any salvage and subrogation, typically with P&C contracts. You would take off any transaction-based taxes such as premium tax, any fire taxes or levies, any retail sales tax, HST, GST, and so on. You take off any insurance acquisition cash flows, and you'd also include the claims handling costs, policy administration and maintenance costs, an allocation of fixed and variable overheads that are directly attributable, and payments to policyholder resulting from any options or guarantees that are not separated from the insurance contract. And some examples of cash flows not included in the fulfillment cash flows would be investment returns, cash flows related to reinsurance contracts held, as these are presented separately under IFRS 17. So under the gross liability, you would not include any effects from reinsurance. Any cash flows related to future insurance contracts, so any contracts beyond the contract boundary would not be included. Cash flows related to costs that are non-attributable, such as, say, certain product development costs or training costs. These are all expensed as incurred. Cash flows from abnormal amounts of wasted labor or other resources are not included. Any income tax payments or receipts that the insurer does not pay or receive in a fiduciary duty. And cash flows arising from the components that are separated from the insurance contract and accounted for under different accounting standards. Now let's look at the risk adjustment for non-financial risk. This is similar to the current provision for adverse deviations, but it only covers non-financial risks. And there are a couple other key differences. One, you need to specify a confidence level and the approach used. Two, you need to consider diversification benefits, and the biggest change is that the risk adjustment represents the entity's required compensation for taking on the risk. It's not the appointed actuary's view of the risk. This is a key divergence from IFRS 4. So the risk adjustment is the level of compensation that an entity would require to make it indifferent between, for example, the following. Say you could fulfill an insurance contract liability with a fixed cash flow, such as $100, or fulfill an insurance contract liability that has a range of possible outcomes, such as, say, 50% times $0 and 50% times $200. So 50% of the time you're going to pay a claim worth $200, and 50% of the time you're going to pay no claim. The expected value of that is $100. So in both cases, the expected value is $100, but depending on your risk tolerance, you would likely pick the fixed $100 over that second option because you're guaranteed to pay $100. Or the converse would be if you were to receive $100 or receive an expected value of $100, you would likely still pick that fixed cash flow of $100. But there could be a level of compensation that if you received in addition to the amount would make you indifferent between these two, and that will depend on your level of risk aversion. So the company would have a certain level of risk aversion, and if you're risk adverse, you would likely take the certain scenario. But there might, again, that compensation, maybe if you had 10% more or 50% more or 100% more, you would be indifferent between taking a fixed $100 or a potential $100 on an expected value basis. And that level of compensation will vary by entity to entity, and that requires disclosure in the financial statements around the confidence level associated with that risk adjustment. Now, there are 5 characteristics of a risk adjustment. So risks with low frequency or high severity. So this would be an example of, say, a large catastrophe such as a hurricane, or a very large death-related event due to a terror attack. Those would have very low frequency but high severity, a high cost associated with them. These would result in higher RAs or risk adjustments than risks with high frequency and low severity. So high frequency would be things like dental claims. They happen all the time, but they're relatively low severity. Or accident claims with automobile insurance, personal damage, or property damage. Those claims are occurring a lot. You have a very high frequency, but very low severity. Number 2, for similar risks, contracts with a longer duration will result in a higher risk adjustment than contracts with a shorter duration. And that just makes sense. If you're on risk for a longer period of time, you should have a higher risk adjustment than if you had a shorter duration. 3, risks with a wider distribution of losses will result in higher risk adjustments, and risks with the narrower distribution of losses would have lower risk adjustments. So what does this mean? Well, risks with a wider distribution, that means that there is potentially very small losses, medium-sized losses, very large losses, and extremely large losses. If it's a very wide distribution of losses, that would have a higher risk adjustment than something that is very narrow. So you only have a very limited range of potential losses. 4, the less that is known about the current estimate and its trend, the higher the risk adjustment. So the less you know about the risk, the higher the risk adjustment. 5, to the extent that emerging experience reduces uncertainty about the amount and timing of cash flows, the risk adjustment will decrease and vice versa. So as new emerging experience reduces that uncertainty, you get more familiar with that risk and more certain about that risk and what it might look like, that will decrease the risk adjustment. Whereas if emerging experience creates more uncertainty in that estimate, then the risk adjustment will increase. IFRS 17 doesn't specify a specific measurement method for the risk adjustment, and it does not prescribe a method, but some potential measurement methods could include the cost of capital method, quantile techniques such as simulation, and then using the value at risk or a conditional tail expectation, or margins on assumptions, which was much like what was done under IFRS 4 with margins for adverse deviation, leading to provisions for adverse deviation on your balance sheet and in your reserves. Now we'll talk about the new component of the building block, the contractual service margin. And this represents the unearned profit for a group of insurance contracts. At issue, it's equal to the present value of your future profits for a group of insurance contracts. And I specify group, not a single insurance contract, but a group of insurance contracts. And then you'll amortize this profit over the life of the contracts. And this eliminates the notion of a negative reserve. So under IFRS 4, the present value of our outflows minus the present value of our inflows would sometimes result in a negative reserve if it was a profitable contract. So say you had $70 of future claims and $100 of future premium. You priced the product profitably to earn about a 30% margin. That reserve at issue would be a negative 30 or a negative reserve. Well, the CSM eliminates that by setting up an equivalent liability. Some other notes is that the discount rate for the CSM is locked in at issue and required to be stored and used in the roll forward of that group of contracts. And you need to store that CSM balance each reporting period. So you need to know what the CSM is at the beginning of the period because you then need to roll it forward to the end of the period. And you also need that locked in discount curve to perform that roll forward. Now, IFRS 17 defines the CSM as a component of the carrying amount of the asset or liability for a group of insurance contracts representing the unearned profit the entity will recognize as it provides services under the insurance contracts in the group. So in other words, it's the unearned profits for that group of insurance contracts. The CSM will be established when, on initial recognition of a group of insurance contracts, the sum of the following results in an expected net cash inflow, or results in a negative number: the sum of the fulfillment cash flows, any derecognition of any asset or liability recognized for insurance acquisition cash flows prior to initial recognition, and any cash flows arising from the group on the date of initial recognition. In formula form, if we have the present value of our cash outflows, such as expenses and claims, minus the present value of our inflows, such as premium, plus our risk adjustment, if that formula is less than 0, then we have a CSM. Now, conversely, we have two outcomes. So if that was less than 0, PV of outflows minus PV of inflows plus your risk adjustment is less than 0, you have a contractual service margin, or CSM. Now, if it's greater than 0, that means you have a loss component, and that means that what you're receiving on your inflows is not enough to cover your outflows for claims and expenses and your risk adjustment. Let's go through a very simple example to illustrate this. So scenario 1, we have present value of outflows of 80. So we expect to pay about $80 in claims and expenses over the life of the contracts in the group. And our present value of our inflows, or our premiums, are $100. So in this case, we had a profit margin of about 20%, or 100 minus 80 is 20 divided by 100. So we priced this product with about $20 of profit, and we also have to set up a risk adjustment, and let's say that was $10. So our present value of outflows, 80 minus 100, is negative 20, plus our risk adjustment of 10 gives us a value of negative 10. And since this is negative, we have a CSM equal to 10. Now let's go over another example, scenario 2. Let's assume that you priced the product only with a 5% profit margin. So again, we have present value of inflows of 100, and we have present value of outflows of 95. So we have $5 of profit, but we also need to set up a risk adjustment of 10. So even though we priced this profitably, our PV of outflows minus our PV of inflows is 95 minus 100, or negative 5. Once we set up the risk adjustment of 10, we actually get a positive number, and this creates a loss component of 5. So the contractual service margin, or the profits that we have in the product, they need to be sufficient to cover the risk adjustment. Now, when we have a loss component, the group of contracts that represents that loss component are known as onerous contracts. And IFRS 17 paragraph 47 states that an insurance contract is onerous at the date of initial recognition if the fulfillment cash flows allocated to the contract, any previously recognized acquisition cash flows, and any cash flows arising from the contract at the date of initial recognition in total are a net outflow. Or in other words, the present value of our outflows minus the present value of our inflows plus our risk adjustment is greater than 0, and we have a loss component. A group of contracts can subsequently also become onerous if the CSM balance goes negative. So if we originally had a positive balance where we had a CSM, that CSM balance can then flip negative, and that would create a loss component. And we'll talk more about loss components in another video where we cover onerous contracts and loss components. Now, the contractual service margin has to be rolled forward every period. So we start with our opening CSM. For a new group of contracts, that would be 0. But for an existing group of contracts, that would be the prior period's ending balance for the CSM. If a group is still open, and that means in the first year, in the first 12 months of that group, contracts can be added to that group through the quarters, for example, if you had an annual cohort of policies. So in that first year of that group, as it's forming that group, you could have CSM for new contracts added to the group. After that first 12-month period, that value would always be 0. There would be no new contracts added to the group. So you take your opening CSM plus the CSM for new contracts added to the group, and then you're going to increase the balance of the CSM for interest accretion. And that interest is going to be using the locked-in curve that was determined for that group of policies on initial recognition. And that will increase your CSM, and that's your expected interest that you'd earn on that CSM balance. And that will show up in the statement of financial performance. And you can compare that to the actual interest earned on the assets backing your CSM to see if you've made money on your CSM or not. You'll then add or subtract, depending on the sign, any changes in fulfillment cash flows relating to future service, add and subtract any effects of currency exchange differences on the CSM, and then you will take out an amount of CSM recognized into profit or loss. This is the amount of CSM that's amortized into the profit and loss during the period, and this will form part of the insurance revenue on your income statement. Taking the sum of these, you would get your closing balance for your CSM. So let's look at a simple example. This example illustrates the CSM roll forward during the period. At the top here, we have the CSM at the beginning of the period. For a new group of insurance contracts, this would be 0. But we're assuming that we already have an open group and it's still open for new business to be added during the period. In this case, the beginning period CSM was $1 million. In the period, we wrote some new business, and that generated CSM from new business. So that increased our CSM by $600,000. Also, we're going to accrete interest on the CSM using the locked-in discount curve for that group. And in this case, it's going to increase the CSM by $48,000. Next, we look at the actual versus expected results on our premiums, premium tax, acquisition expenses, and investment components. So in this case, we had expected premiums of $250,000 over the period, but our actual premiums were $252,500. So that $2,500 variance is going to, instead of hitting the income statement right away, it's going to increase our CSM balance by that variance. The expected premium taxes were $66,250, but our actual premium taxes were $6,300. So again, we have a $50 negative variance, and that'll bring our CSM down. Our expected acquisition expenses were $65,000, and our actual acquisition expenses ended up only being $60,000. So we have a $5,000 positive variance, and that increases the CSM. And then finally, our expected investment components, so for example, say cash surrender values, were $30,000, but our actual investment components ended up only being $25,000. So again, that's going to be a variance of $5,000, which increases the CSM. The next item shows any experience adjustments or assumption changes on our BEL and RA. In this case, we put through assumption changes that increased our BEL and RA in the period, and as a result, that decreases our CSM by $160,000. In this example, all funds were in Canadian dollars, so there were no currency exchange differences, so no impact on the CSM from that. And then finally, we need to amortize some of our CSM balance into income. And this would represent the CSM that is earned in the period and will show up on the profit and loss or in our income statement. And in this case, we have $149,000 that is being amortized. And that brings our ending CSM balance to $1,351,450. So the items that increased our CSM were the addition of new business. And once a group of contracts is closed, you'll never have any more CSM from new business because you can't add any more contracts into the group. This would only happen in the first year that a group is around. Interest accretion on the CSM also increased the CSM here, and it will always, unless you had a negative interest rate, but that's pretty rare. Going forward, though, that could happen, but for now, we're assuming we have positive interest rates, and that increases our CSM by $48,000. The variance of these cash flows could be negative or positive depending on the period, and these experience adjustments could be negative or positive depending on how the experience emerged or what assumption changes were put through. And finally, the CSM amortized into the period will always be a reduction because we'll be amortizing that profit over time and reducing the CSM over time. So that concludes our video on the general measurement model or general measurement approach. Thank you for watching.